this video. All right, awesome. So welcome everybody. My name is Miguel Reynoso, and for those of you who do not know me, I am the life insurance manager here at Claro Insurance. And today we are going to be talking about mortgage protection. This is going to be a quick training on how to utilize the ANICO GUL for mortgage protection. Okay, this is one of those products that we recommend for mortgage protection. There's all types of different ways to use all the different products that exist out there in life insurance, including terms, IULs, GULs, whole life policies. Just depends how you want to structure it for your clients. But today we're going to be looking at how to structure a GUL policy for someone who wants to utilize it for mortgage protection. This comes with a guaranteed return of premium rider, which is awesome for those clients who want to have that protection for their mortgage, but also they want that return of premium in the event they don't ever use it, right? If they outlive their policy. So we're going to be talking about that specific product, and I'll be sharing some videos about the ANICO illustrations and about the product and how to navigate the ANICO dashboard. I have some videos that I'm going to be sharing with you here, but I'm going to go over a couple things before then. Again, this is going to be probably around a 45-minute training. This is just a quick training to learn a little bit more about how you can use your license in the products that you offer. For those of you who are maybe just getting started in the business, you're looking for ideas on how to help your clients. And for those of you who have been in the business for a long time and understand products like mortgage protection, this is a good way for you to learn about how to use ANICO, right? One of our carriers here, with the GUL. If you haven't seen it used before, this would be a good way for you to understand how it's used and understand how to navigate the ANICO dashboard if you've never been on it before. So I hope you guys get a lot of information from today's call. I'm definitely going to open up for questions towards the end for this type of product. In the meantime, enjoy the presentation, and give me 1 second. All right, here we go. So what are we covering, right? This is a very basic question, right? Who is looking for mortgage protection? These are the kind of questions that you should ask yourself when when you want to start offering this kind of product. And we're going to be talking about using, like I mentioned, using ANICO's GUL with the return of premium. Okay, what is mortgage protection? The basic definition of mortgage protection is it's the same thing as mortgage insurance, right? It's an insurance policy that protects the mortgage lender or title holder if the borrower defaults or on the payments, passes away, or is otherwise unable to meet the contractual obligations of the mortgage. Right? So you're essentially covering the mortgage balance an insured has in the event they pass away or they get sick and they're no longer able to maintain those payments. Right? The mortgage will go into they'll be backed up on their payments. Mortgage lenders are going to be very worried about that. And a couple of things that happen, right? When people are not making their payments on mortgages, they're either going to take the home away, go into foreclosure. And lenders don't necessarily want to go down that route, right? They want to make sure that the mortgage, the loan that they've given this person, the responsibility that they've given this individual gets paid, right? So they can make their money, so they can make their profits. Now, mortgage protection is going to help an insured, make sure their family is never left without a home, right? Make sure that in the event something does happen down the road, right? Life is not guaranteed. We all know that. So in the event something does happen to them, whether they get sick or they pass away, their family will always be have a roof over their head, right? There's a sense of security, a sense of comfort that the insured is going to have, knowing they have this protection on their life, right? They're on their on their income. So who are our prospects in this situation? When we're talking about finding clients for mortgage protection, we're looking at homeowners, right? And you guys can put in the chat there. Who else do you guys think would be a good prospect to find opportunities to offer mortgage protection? We also got real estate agents, right? Agents are constantly working with new home buyers, or maybe they have a book of businesses already that they can offer these products to, right? So you want to build those kind of relationships with real estate agents. That way you can get some great referrals so that you can offer their clients a mortgage protection plan. Real estate websites. It's a great place to go and see if certain real estate websites like Rocket Mortgage or Zillow, these kind of companies, Redfin, they sell leads as well that you can offer mortgage protection to those people who are either searching for a home or selling their home, right? There's ways to get access to those leads, right? We can get into that at a different time, but these are just ideas I'm throwing out there for you to start looking for certain prospects and offering this mortgage protection. Real estate investors, right? Real estate investors are constantly building on their portfolio. They're constantly buying more and more properties, meaning they are constantly needing more and more protection over their investments, right? They want to make sure they're protecting their investments with a great insurance plan, a great mortgage protection plan. So, you know, looking at these ideas, you even have to stop and think, like, have I even talked to my neighbors where I live? Have I walked down the street and door knocked, introduced myself, say, hey, I'm your neighbor. You know, I've been living here for so much time. I'm a life insurance agent. I'm a mortgage protection specialist. And you know, I wanted to offer you my services. In the event you ever need anything, here's my card. I'm right down the street. I live around the neighborhood. Well, however you wanna approach it. But hey, your neighbors are right there. There's their homeowners living right next door. So why not introduce yourself? You know, be that neighbor that everybody knows. If they need you, they can come and see you. It builds a certain sense of trust as well in the neighborhood, right? Giving them the opportunity to know who is next door. So it gives you it's just a reason to go and introduce yourself, right? By the way, I'm also a life insurance agent, and I'm a mortgage specialist. You know, if you ever need me, here's my card. Here's a brochure of some of our mortgage protection policies. You can take an ANICO, which you'll see right now how to access those brochures. These are absolutely free to you. You just got to request them. You can go print them as well if you want. If you don't want them to ship those brochures to you. I prefer to have the brochures that these carriers send us. They're very nice. They're already folded. They're, you know, great presentation. I use those, right, and go around and pass them out. New communities, right? When you see some of these new communities being built in certain areas that you're seeing a lot of these, like, you know, new homes being built, these properties where they're building 300, 400 homes. Like, why not introduce yourself to those agents that are there, right? See if you can build a relationship with them and see if they can make some recommendations to those clients, right? Figure out a way to make it worth it for both of you, right? There should be certain ways to make that kind of relationship work, right? So, you know, in the past, just an idea. In the past, we've, you know, with other companies, we've recruited certain agents, real estate agents that are very good at what they do. They don't have the time to go and sell life insurance, But them having a license, you can do splits with them, right? You can be a split agent on the policy, allowing them to get commissions on those sales, right? They give you the referral, you do the sale, you put them as a split agent, and that will get them half of the commissions on that sale. It's a great way to either recruit and build your team and start building that flow of referrals for yourself. It's just another sales outlet for you, right? Someone who's going to market for you, but they have an advantage, right? They have their interest in sending you referrals because they're going to get paid every referral you sell. And so that's just one idea. Again, you can help them getting their license. You've already done it. It's super simple to go and apply for the license. The test is not that difficult. It does require some time on their end. But hey, if it's going to make them a few $1,000s a month, without them just sending you their referrals, why wouldn't they do it? It would be worth the investment of time to go and get that license to be a split agent on these policies, right? So just throwing some ideas out there on how you can prospect certain people. So again, this is just a way to prospect your clients. Today we're going to be talking about ANICO. ANICO is American National, right? For those of you who are not contracted with ANICO yet, I recommend you guys make sure you guys submit your contract with Claro's contracting department to make sure you guys get this contract, right? ANICO is a great company. They have a great IUL product. They no longer offer term, but one of their biggest benefits, and this is comparing a lot of the carriers that we have and other carriers that I've worked with in the past and other carriers that I've done research on, American National has a really great living benefit trigger, or amount of triggers, I should say. So their triggers on living benefits are amazing. They have a lot of triggers. They have about 21 triggers now, right? 21 triggers for living benefits. Okay, if you want access to this form on their they have a sheet that shows you all the different triggers. I recommend you go to their website and look for a living benefit writer, and it'll tell you all the triggers they have for living benefits. It'll show you, what would be the reason for, what triggers they have for critical illness, what triggers they have for chronic illness, terminal illness, and also for critical injury. Okay, so they have, again, they're really, really great for living benefits, which is another reason why I recommend this this UL that we're going to be talking about today, the GUL for the mortgage protection, right? And we'll talk about another couple of other products that you can use for mortgage protection. But talking about this ANICO guarantee universal life, the GUL, we have a death benefit, right? To cover the mortgage, the balance, whatever they owe. They owe a certain amount of money on their mortgage. Well, we have a death benefit in the event you pass away. Hey, your family's going to receive this money tax-free to cover that mortgage. That way your family doesn't have to, remain end homeless, because they're going to struggle making those mortgage payments after your income is gone, right? When you pass away, your income also passes away. It's gone. It's no longer there. There's going to be a certain struggle there from the family, right? So living benefits. It comes with the living benefits. In the event you get sick, a critical illness, a chronic illness, critical injury, or even a terminal illness, you can get up to 100% of the death benefit in while you're still alive, to make sure that you're covering those payments. That way you're never going to end up homeless. You're not going to end up falling behind on your mortgage payment and end up having to foreclose on that home. So you got the living benefits here as well that will help you protect that that monthly payment. And ANICO's Guaranteed Universal Life has the return of premium rider. Okay, so in the event they don't pass away, they don't end up using this policy after a certain amount of years, after 20 years, after 25 years, because you got to think, right? A typical mortgage is anywhere between 20 to 30 years. Okay, if it's a brand new homeowner, it's most likely going to be about a 30-year mortgage loan that they're on. Okay, meaning, hey, they got a long time to pay that. They got to make sure they got the right protection over that loan. And so these return of premium writers will return all of the premiums paid, right, up to a certain amount of years. So after 20 years, after 25 years, it's going to return that premium they've paid up until then. And that will give them the opportunity to use that money or utilize that return of premium to either pay off their loan or because you still have interest that you got to pay on these loans. If they're paying the minimums every month, that means that they're gonna end up paying the the principal plus all the interest over the years. So come 20 years, they have a nice lump sum to put towards their loan to pay down that loan and save on interest over the years. So this is going to be a great opportunity for them to be able to save that money, right? So, and you got to think about this. They got the coverage, right? Let's just use an example. They have a $400,000 life insurance policy. They got that coverage, the $400,000, in the event they pass away or get sick. They're going to get that money and pay off their loan, right? Their family's going to they're going to remain with the roof over their head. Now, they don't pass away and they have all of these premiums they paid up until then. They can withdraw those or they can get those premiums paid back to them and utilize that money to pay their mortgage or pay off a huge balance of their mortgage, or maybe even pay it off, right? Now, what do you call that when you're paying so many years for a protection, $400,000 in coverage, and then they return that money to you at the end? That's free, right? That's free coverage. That's a free policy, because they're going to return all that money back to you when you get to that term period of time. Okay, and we'll look at those options in a little bit, but hey, that's free protection. Who doesn't want that? Right? So we got to look at it in that certain in that way for these clients. When you want them to understand this kind of product, it's like, look, you're going to pay for this for 20, 25 years, and you're going to remain protected in that time. In the event something happens to you, you have that money to cover your loan. But hey, listen, you get to 20, 25 years and you don't end up using it. Well, you're going to get all those premiums back with this return of premium rider. You're going to get all of these premiums back, and you're going to be able to pay that loan down, right? So it's a free coverage here, okay? And you also have cash accumulation in these policies. Okay, you have cash accumulation, access to the money. You have access to that cash accumulation. In the event you need it before then, you actually have access to the cash accumulation. This is not the same access to the premiums. This is access to your cash accumulation. It's separate. Okay, so we're going to look at how to navigate the ANICO dashboard. We're going to look at that right now and figure out and understand how to navigate through their dashboard. If you have access to it, I recommend you follow along with this video. And I also recommend, if you don't have access to this, take notes, right? Take notes, make sure that you're writing down where to access these, what kind of information to put in certain fields when you're running quotes, and also the name of the certain products that you're going to be learning about today, which is the GUL. All right, so let me go ahead and open up this video for you guys here, and we're going to go over the GUL. Okay, this gentleman here is going to be talking about the GUL. Give me 1 second though. I think I got to make sure I am sharing the audio. I don't think I was sharing the audio. Here we go. All right, so here we go. And then after these, I have 2 videos I'm going to show you. After these 2 videos, I'll open up for questions.
All right, so we're ending with the term. Now the next step up in our products is our guaranteed universal life. All right, guaranteed universal life functions like, and I'm going to say it this way, like permanent term insurance. Right? Even though the guaranteed universal life is on a universal life chassis. So when you see a policy and you see an illustration, you're going to see some of the same, modified endowment contract numbers, maximum premiums, minimum premiums. You're going to see some of those things. It does not work like that. When you run a GUL illustration, a guaranteed universal life illustration, the number you see presented is the premium. Don't raise it, it does no good, right? Don't lower it, it ruins the product. It is what it is. And so it functions like permanent term insurance. It comes with all the living benefits and goes through all the accelerated underwriting. Let me take you to the website, show you where the product page is, and there's a couple of things about it that make it unique in the industry. If you're presenting this to individual clients, business owners for buy sells or for key person, you're going to be the only agent in the room showing this to the client and making this a possibility for them. So let me go back to our main website, and I'm going to reset this to the home page so we get a fresh look. All right, so when you come here, let's hover over life, come down to the signature guaranteed universal life, click on it, and it's going to take you to the product page just like we did with term. So all the same premium bands are down the left side. You're going to see the overview of the product down the middle, and any brochures, sales ideas, cash out rider studies, anything, then Spanish brochures are all down the right-hand side. So I'm going to open up the brochure quickly because I want to show you the return of premium features. That makes it unique in the marketplace. And this product has the highest caps and return of premium that exist in the industry. And I want to talk to you about how they work. So let me scroll down to the page where they are. Okay, this is on page 6. So when you're looking at the brochure, flip down to page 6. And we got a breaking point on this. We have the under 250 return of premium numbers and then the over 250 return of premium numbers. They function the same, they're just the amounts are just set a little differently. So let's look at the death benefits between $25,000 and $249,999. So in this product, right, from the day you purchase it, 15 years later, if you do not want the insurance any longer, if it's served its purpose, you can give it back to American National and you can get 50% of your premium returned to you. Tax-free return of premium, because it's return of premium, there's no interest on it, there's nothing to be thought about. You've turned it in, we give you your money back. 20 years from the date you purchased it, you can get 100% of your premium back. And in the 25th year, if you keep it 25 years, then you can also get 100% of your premium returned to you. With a maximum cap, so depending on the age of the client now, there's a maximum cap on the return of premium of 45% of your death benefit. All right, so think of it just like you would when you're thinking of indexing. You're going to get all of your premium back up to the cap of 45%. Now, if we pop over 250, you're going to see that increases in the 15 year to 65%, and the overall cap increases to 65%. Other than that, it's exactly the same. You just have a higher cap on those higher face amounts. Right? And you really won't run into that overall cap unless the client is older in age. Typically, ballparkish 63-ish and up maybe, but it'll show you in the software. When we get to those illustration, it'll show you there exactly what the numbers are.
All right, awesome. So that's great information. I hope you guys saw that. So if you guys have questions about the caps and how that works, and if you guys didn't understand what it meant as far as like the 45% of the cap or 45% cap of the death benefit, let's just use a quick example. If the insurance policy was for $100,000 and 45% is the cap, so they can cash out up to $45,000 of that death benefit if they have that, if they've already paid into that policy up to $45,000 and they go and they cash out, they can only cash out up until $45,000, which in most cases that's going to be a little bit higher than the amount of premiums they've already paid into the policy at that time. Okay, it's going to be much less than that. So the cap is 45% of the death benefit, not 45% of the premiums they paid. It's 45% of the death benefit amount. Okay, so just want to clarify that. So the next video we're going to look at is the illustration and how it's how they run it, how you click on the writer, make sure that it has the writer, how to find the right product when running an illustration. Okay, so this is about a 7-minute video, and after this video, I'm going to go ahead and open up for questions. If you have any questions in regards to mortgage protection ideas and finding clients and whatnot, I'm more than happy to open up for that. So let me go ahead and play this video now.
And then pick your premium mode. One of the excellent things about our software is we're sitting here with Mrs. Happy, all right, Mrs. Happy Alliance client, and you've shown her the term. Now, if you want to show her the GUL as an alternative to get her money back instead of spending money, you just come over here to the action button, create new illustration, and we're going to have 2 illustrations open for her right here in the same software. You don't have to close one to do the second one. So we choose Guaranteed Universal Life, click Create, and there we go. You see up here in the top, this is the term quote that we ran earlier, and this is now the new GUO quote you can run side by side. So if you're presenting something like this, you can toggle back and forth between the two. All right, so if I remember right, we ran Mrs. at preferred. We ran her at 250 grand. Now, here's the choices you get to make on the product. You get to choose how long it lasts. Remember I said it was permanent term? Well, you're not buying 10-year, 15-year, 20-year, or 30-year. You're buying it to last until an age. So when you drop this down, you get to choose whether you want the insurance to last to 95, whether you want it to last to age 100, 105, or 121. So let's set her at 105. 105 is a long time. So let's solve it for 105. And then pick your premium mode. This is all that we're doing. Come down, pick whether you want it to annually, monthly, however you'd like for it to be paid. And now, folks, you're done setting up your illustration. All right. There's nothing else to do. There's no allocations. There's no distributions. There's nothing else to do. You can come over to the left side, click on values, and you're going to see the premium numbers, the same preview page that we looked at on the term. So as we review that, again, here's Mrs. Client, here's the product, her rating, face amount, the initial premium, which is the premium, all right? 7 paid premiums, single guideline premiums, none of that applies. Now ignore that when you're looking at this. It's just here. And here under riders, you're going to see all 3 return of premium years and all 3 living benefits listed. Right. And just scroll down and you're going to look that the premium on this never, ever, ever changes. So can you imagine this young lady can get $250,000 and all the living benefits and that return of premium, and it's $125 a month, and it'll never change. When she's 85, it'll still be $125 a month, roughly. All right. Again, looking at the illustration, you can go here and preview the illustration. I want to show you that quickly because this preview on the screen I showed you does not show you the return of premium numbers. And I want to show you where those exist. They exist in 2 places in your illustration. They exist first in the summary page, which is right here. So you can see in the 15th year, 20 and 25, it shows you the return of premium numbers. In the 15 year, she's got 13,000 coming back. 20th year, 28, almost 28.5, and in the 25th year, 35.5 if she wants to turn it in. You also will find these down on the main body of the illustration, down on the ledger part of the illustration. So again, in the 15th year, you're going to see her return to premium. In the 20th year, you're going to see the $28,000, and in the 25th year, you'll also see the $35,000. Now, not only can you do this on an annual basis, right, depending on the client and how they want to structure the policy, you can pay it in full in 10 years. So if you want to show this young lady that, just click on the action button, open up a new illustration, You can have another one sitting right here. Come down, pick out guaranteed UL, create. You're in here now, you've opened up a brand new one, so we're starting from the top again. So we're going to change her class to preferred. Okay. We're going to change her solve criteria to age 105. We're going to change the face amount to 250. And down under the premium options, I'll highlight that a little bit. Under premium options, it says pay to age 105. Well, if she wants to be done in 10 years, you can say pay to age 50. And if you hit tab, it changes for 4 years, or you can come over to the 4 years and you can say, all right, we want to do it for 15 years. And the software will then calculate what it takes to make this policy last all the way to age 105, but the client is paid for it in full in 15 years. So once you set that up, again, it's that simple. You're done. Click values, and you'll get the preview screen to come up, and it will show you then the $2,612 for 15 years, and then you can see that the insurance lasts until age 105. All right. Also, for older clients, right, if you have someone that's they got money they want to leave to their kids. Maybe they have an older whole life policy that's now been paid up and it's not got the face amount on it that they expected it to have. Maybe they've got non-qualified money in an annuity somewhere or in a bank account somewhere, and the whole idea is to leave that to their kids. Well, you can take this product because you're not worried about cash value. You might like the living benefits, which it comes with, but that cash value is not your purpose, right? So an IUL wouldn't be the best fit for that scenario. You can come in here and do a single pay scenario. Now, single pay won't work so well on a 40-year-old, so the results are not going to be what you would look for. I want to show you how to how to set it up and what it would look like.
All right, all right. So he's going to get into more complicated things. This is not going to work for mortgage protection when you're doing single pay. You don't necessarily want to offer that to a client. You want to stick to the guaranteed return of premium rider. So with that, you guys saw how to fix that illustration, how to set it up in two different ways, right? One, you can pay it off sooner, which is going to give you access to those return of premiums much sooner. If you guys noticed in the illustrations or in the illustrations he was running, you notice that at the 15-year mark, he was getting a lot less than he's paid into, or she, that she had paid into premiums. The client, Mrs. Happy had paid $21,000 in premiums, but was only getting back around $13,000. If you notice that at the 15th year is obviously not the best time to take that out. It's kind of like the 15-year surrender charge that some of these carriers have when you're paying into an IUL, right? So in this case, it's a 20-year surrender charge because at the 20th year, if you noticed, the amount of premiums they paid and the amount of premiums they had access to were exactly the same, right? They paid $28,000 in premiums up to 20 years, and they had access to $28,000 in return of premium if they wanted to cash out, right? So great illustration. That's why I really like the ANICO GUL for this kind of situation for mortgage protection. Number one, it's affordable. It's not expensive. It's going to be very similar to your term policy that has a return of premium rider. For mortgage protection, you're offering this return of premium rider, people are going to be very happy. If you want to sell a homeowner a very cheap insurance policy with no living benefits, with no guaranteed return of premium, it's not going to be the best option for homeowners. Homeowners should be able to afford something that, especially if they're homeowners, right? They should be able to afford something that is going to, number one, guarantee some kind of return at the end, and give them that free, essentially that free life insurance protection for, that 15, 20-year mark, where then they can access that money, pay off their loan, or bring down that loan payment so they can save on interest. But at the same time, have that living benefit protection rider, have that life insurance protection as well. over their home and protect that home in the event they pass away. So that's it for today. I hope you guys got some great nuggets out of this one. I'm going to go ahead and open up for questions. If you guys just give me a second, I have to allow. There you go. All right. If you have any questions, feel free to ask. If you guys have any questions and want to write them in the chat, feel free to write them in the chat. But any questions in regards to today's training? Nope. Yep, Lesbia, adelante.
Okay, yes, good afternoon.
Good
I'm
afternoon.
a little confused because so you said that ANICO doesn't have any more terms. So
No,
that's
ANICO in December 20 something, they actually stopped offering the term. People who have their term policies with ANICO obviously still have them active. They just
mhm.
stopped offering it.
Oh wow. So
Yep.
so these GOL, that is wonderful, but so it is only for 15 up to 30 years, which is the mortgage usually last.
So if you noticed, they actually, it covers the client up to 105 years old, and the payment never changes. You're always going to pay the same premium. The way it's set up is up to 105 years old, you're going to pay the same amount of coverage, right? The same amount of premium, sorry. The same premium. It doesn't increase after 85. You're going to pay the same premiums up until 105. However, if the client decides to cash out at 15 years or cash out at 20 years or even 25 years because they don't no longer need the protection, their home is paid off, then they can cash out that money, right? They can get that return of premiums, 100% what they paid into it, or up to 45% of the death benefit,
Mhm.
which is what he shared in the 40 up to 45 or up to 55, depending on the amount of coverage. Yeah.
Okay. Okay. So if let's say the client um would like to just to keep it a little bit longer than the 30 years, uh they can cash it out after 40 years, for example. And they
Correct. Yeah.
okay.
Yeah.
Okay.
But remember, when you get to 40 years, the amount of premiums that you've paid up until those 40 years may be higher than that 65% cap or that
Oh,
45% cap. So the idea, even when they do when they do go to the 40 years and they withdraw it, they're going to get up to 65% or up to 45% of the death benefit, which is still quite a bit of money, right? Still a big return.
okay. Can they
Mhm.
convert this policy? Um, so let's say they want to get the money back to pay off their mortgage. Can they convert it to a permanent, to an IUL, or to
Well,
home?
technically the GUL is a permanent policy, which is why it covers them up to 105, right? It's a universal life insurance policy. So it is that whole life permanent life insurance coverage. So technically they wouldn't need to convert it into an IUL. If they wanted to convert it into an IUL, um, I believe the UL is convertible over to IUL. I know for certain, for certain like NLG, you can convert a term into an IUL. With the GUL, I'm not 100%, but I will double check and confirm that is possible. But technically, Lesbia, the UL is a universal life insurance policy without that indexed growth potential, right? This has cash accumulation, but it's limited to the amount, to the what interest it's earning. It's around 2 to 3% that it's earning inside that cash accumulation account. But the goal with this kind of product is more the return of premium, which is why it's a stable premium, annual premium for 105 years. It doesn't increase. It's always going to be the same.
Perfect. Well, that's wonderful. I think that's a wonderful product. Thank you.
Yeah, I think you know, a lot of people try to use the term policies. I know, Lesbia, you have some experience with using a term policy, a guaranteed a term policy with the return of premium rider. I would recommend to go into ANICO and compare the GUL with the term that you have to see if they're pretty close to pricing. As far as you know, what you would pay for a GUL for a permanent policy or a term policy for 30 years with the return of premium rider, and see if they compare. You know, for me personally, I think the GUL would be a better option just because you have that permanent insurance coverage. Here's the thing: when you're talking about mortgage protection for clients, mortgage protection, personal or private mortgage protection policies, or in other words, a life insurance policy for you, for the client, for the insured, is it's you can move it from property to property, right? Sometimes people will, you know, be in a time of their life where they'll buy another property, so they're going to continue to need mortgage protection, right? So they can actually transfer their mortgage protection from it's a term that we use, right? You can transfer it from each from lender to lender. In other words, the protection goes with you. I'm not saying you have to transfer it and actually do paperwork and say, hey, listen, you know, Bank of America, I have insurance coverage, you know, here it is. No, it's just a term that we use when we talk to clients. Hey, by the way, your mortgage protection is transferable from lender to lender. What we're saying there is it's your life insurance policy. You can have it as long as you want. You can have it for another 20 years. You're still going to continue to pay the same amount for that coverage. And you still have access to that return of premium if you ever decide to give that policy back and cash out, right? So you can utilize that money to put it down on a different home, etc., right? There's a lot of different ways it can utilize this money. That's more in you know, more detailed conversation when you're talking to a client. What are their goals? Do they want to invest that money? Do they want to pay off their loan when they get to that amount of years? You know, there's going to be different advice for those kind of situations once they get that money back. But great question. Thank you, Lesbia, for your feedback. Any other questions before we end today's call? This recording will be saved and will be sent out to you guys in the next few days. So thank you guys for being here. Thank you for your attention, your time, your willingness to learn. And we'll see you guys at the top. Thank you guys. Have a nice evening.
Thank you.
Thank you.